We've heard a lot about inflation in recent years, particularly for young people with university HECS and HELP debts, that inflation went up substantially post-COVID. But what is inflation? Inflation is essentially the cost of living going up, and it's a silent, slow killer of your money. It will devalue the value of your money over a long period of time. You will not see it in the short term. Now, we often call it the death by a thousand cuts. It's just a slow grind. You'll look back in 10 and 20 years and say, I was too conservative. How do you reduce the risk of inflation affecting your money? Well, you need to invest in an area that's going to get a return comfortably above that inflation, and that is growth assets. Now, growth assets can be direct property, listed property trusts, infrastructure, the share market, assets that can grow. So to buy these assets, particularly the share market where I spend my time, investing into high quality businesses, you now need to accept a different type of risk. And that is a short-term risk of the ebbs and flows of markets, the ups and downs, short-term volatility. But the one thing I say to all my clients, that short-term volatility is a far lesser risk than the long-term eroding effect of inflation on your money. So if you can learn and understand that short-term volatility of share markets is normal and expected, then you can invest there with a long-term view, and inflation will not be a problem for you. But if you invest too conservatively over a long period of time, you better die quick. Your money will lose its purchasing power and you'll run out.